Hey folks, welcome to another edition of FOMC and interest rate hiking. So we are now on schedule for this evening to have a 50 basis point hike from Jerome Powell and the boys and girls at the Fed. We've had both sides of the market today. We started off the European session in equities, kind of holding an upper range above pivot across the board. We had a spin to the downside since I've been off the desk, and after the open, definitely an opening drive to the downside. A little bit of a late drive, and we've all but recovered that now. So sitting 0.15 up Nasdaq, zero point 0.3 up on SPOs, and 0.35 bips up on the Dow right now. So certainly the lows are supported right now. Oil as well. Well done to Ollie in the room, taking down a major scalp there. I was giving him a bit of a hard time about buying 106.20s today, but he has certainly taken that home and taken at least about almost $1.50 out of this now. So that's a hell of a move. So congratulations, man! Really, really lovely move, and really great targets up the top there. 107.58. Lovely, lovely, lovely. Well done. So, really, we can look. I mean, we can go both sides of chatting about this interest rate hike here, but essentially, what we're looking forward to is, a 50 basis point rate hike. As always, there are people talking up and down the markets as to the balance sheet reduction, blah 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 blah. At the end of the day, these markets, to a huge degree, have known for a long time that the cycle is going to be 50 basis points in May, June, and July. And then there is the looming threat of 75 basis point hikes thereafter to close out the year. Now, that's something that I've kind of held on to in my brain from the last meeting. So anyway, look, we can talk about this all the way up and down, but what we're going to get in 12 minutes time is the rate decision from the FOMC as to exactly how much they're going to raise by. It's most probably 50 basis points. A hike here, as an outside scenario, a hike of 75 basis points is not expected. I don't think that's priced in at all. So there's a lot of people saying that that's what they should be doing straight up the front. I mean, they're talking about doing 50 basis points in May, June, July is front loading it. I mean, certainly choosing to do 50 basis points instead of quarter basis point, 25 basis point hikes, such as the ECB would be planning to do starting in July, would be, a bit more of a dovish hike, if you like. But, it's going to be 50 basis points. So what we've seen, we'll go over to the charts now, right, and take a good old gander at what we've seen today. So I just bring up and transition over here for you guys. So look, quite a murky NASDAQ chart here, but really if I blow this up onto full screen and we kind of look at this blue range, right? So we kind of first came into this range back on the 11th of April. I'll show you where I get this range on a higher time frame chart in a second. From actually, I'll remove the 500 moving average here because it's a little bit distracting at the moment. So yeah, basically, once we came into the range back here, 11th of April, this market really did start to get very bumpy. Not very easy price action. Large sort of range on the day. Since then, high volatility, about 2.7% there. I mean, since then, we are down. We're at market right now. We're kind of down 6.79%. Lovely continuation down through the trend, earmarked here by a bear flag. Absolutely clean as a whistle bear flag here. Also, a break down on this trend. So really technically, quite well respected. I would say actually once we broke this bear flag, then it was pretty much in the post that we were going to do the bottom of the range, which I had actually previously just as a bit higher than what we have now, but I've adjusted that today. 701s on the low in the range. Does this mean that we've traded the low of the range? We just get back on up here? Toot sweet. I don't think so. But I certainly see an open gap here where we had the reopen on Globex from Thursday the 28th into Friday the 29th last week. We didn't actually strictly close that gap. So it remains open, and that's 13,464 quarter on the upside. If we go out on the daily, and I am really going to get around these three main equities before we get the decision in 8 minutes time. So here you go. Here's the daily bars, and you can see really this range coming into play from the low of the 1st of February 2021 into the highs that we saw on the 16th and the 29th of April 2021. And so, we're back in prices that we were trading at a year ago. And where are the buyers? So we've heard a lot of that on Bloomberg today. A lot of people talking about cash being the best position at the moment. Paul Tudor Jones, the great Paul Tudor Jones, really very uncertain about where we're going in the market right now. Everyone's saying that the Fed are in a very difficult position now, trying to engineer a soft landing. So, raising at like front-loaded hikes of 50 basis points 3 times in a row, then potentially going to a 75 basis point hike, towards the end of the year, and potentially doing that twice. Does that sound like a soft landing? Is the market just going to price all that in over, this quarter, the next quarter, and we're putting in the lows right now for the year? When I say that, when it comes out of my mouth, it does not sound probable. It does not sound probable under what we've seen. Just to kind of get some maths out of the way here, from the high to where we trade right now, we're down 21.83% on the NASDAQ. Obviously, the 20% marker is technically a bear market. I was talking about this with the elite team earlier on a call. The big thing here was the 100 moving average exponential crossing over the 200. And as you can see, the market just got the hell sold out of it since then, down to the bottom of this range, 12,701s. All right, that's enough on NASDAQ. I'm not going to get into talking about is tech cooked? Is it not? Where's the value? Blah, blah, blah. I'm not getting into that story right now. I think there's value out there to be had if you recognize and understand value, and people have multiple different ways for gauging that. All right, cool. So here's the SPOOs. Big channel trend up here, going all the way back. Really started 2018. Bit of Volmageddon here, actually. This is December 2018. Volmageddon was way back here behind my head. I'll just take my head off the stream there. This is Volmageddon, of course, when the VIX kind of essentially when the VIX broke everything. Just back here, came into this channel. It's kind of irrelevant right now, the channel, because essentially where we trade right now, I know I've talked about this a lot, but there is an existing open gap on the SPOOs from month futures, back adjusted, 39.96 evens down to 39.76 evens there. Okay, it's there. I'm just pointing that out technically. All right. So we are now below this range from the highs of the 7th of May 2021, which was then subsequently the low of the 19th of July 2021. So a nice sort of line in the sand level there, and we're now trading well below. You can see here in the sell-off on the 24th of January this year, it's just such a great buying opportunity at the bottom of that range there. So we're now trading below pretty much, levels that we haven't seen for, since the start of the year, obviously. But before then, we're talking about June last year. So, while obviously, a dovish hike here would be, a 25 basis point hike. I don't see them doing that, but, you just got to be open to it. Well, then I think we're going to be absolutely stonking to the upside, as these markets love to do. The Dow, I'm not going to get too much into the Dow. We are sandwiched here pretty much. 4 minutes to go now until the data. We are sandwiched between these sort of lines in the sand of 33.179s to 33.303s on the top, and you can see we've been trading in that range since we dropped last Friday. Showing you this on the daily chart. you have to remember there's a lot of value in the Dow companies, a lot of dividend paying stocks in there. It's real value stuff. So for this to just sell off down through this range, not without a fight, and it's really going to be I think it's going to be dragged down here in a correlation drag if that happens, that rather than anything else. And I just think there's going to be so much opportunity of value should we, print south of the lows that we've seen this, of Monday this week so far. So that's really it for me for these markets. Oil, never a mover on FOMC. Euro, dollar, big movers. Cable will get abused by any dollar strength here, as always, but euro will suffer the worst on any dollar strength. We have talk of topping out on the Dixie at the moment. All right, 3 minutes to go. I'm going to leave it there, and we'll hand over to the Squawk, and he can lead us in. So brought to you by newsquawk.com. All right, I'm just going to shush my mic and let the Squawks take over in a second. Straight away, right now, you're seeing actually the Dow getting a bid here, kind of getting a jump on things. Quite busy. We're 2 minutes out. Just waiting to get the Squawk on. Sorry about this, guys.
And 1 minute now till the FOMC rate decision. I'll lead in with the hike increment over the Squawk. So if we do get to 75 to 1%, I'll just say 50 basis points and so on. Then I'll go through with comments from the statement.
So if we get 1% hike here, I think we're going to see interest on the downside straight away. But actually, for reasons not talked about right now, I think that's going to be bullish in the medium term. Seeing equities moving around quite a bit here now ahead of this decision. 15 seconds.
10 seconds. $50 basis points as expected. Policy was unanimous decision. It says we'll begin trimming balance sheet on June 1st. Initial cap on monthly balance sheet reduction set at 30 billion for treasuries and 17.5 for MBS. After the 3 months, caps on balance sheets will rise to 60 billion for treasuries and 35 billion for MBS, as expected there. But the June 1st, perhaps a bit later than it.
Okay, so I'm just going to mute the Squawk here. All right, you've got the 50 basis points.
Excess reserves does also rise by 50 basis points to 0.9%.
Right, you're seeing equities taking a bid on this. Okay, so that means, it has been priced in.
Ongoing increases in the target range will be appropriate.
Just bring up the VIX for you.
Says expects inflation to return.
You're seeing the VIX now dropping off here. Not a huge amount.
Firming. Fed says inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. I note the invasion of Ukraine is causing tremendous human and economic hardship. implications for the US highly uncertain, but in near-term invasion and related events likely to create additional upward pressure on inflation and weigh on economic activity. They also mentioned the China lockdowns, saying they're likely to exacerbate supply chain disruptions. Fed saying they are highly attentive to inflation risks. They say although activity edged down in Q1, household spending and business fixed investment remain strong. Job gains have been robust in recent months. Also, the Fed says.
Okay, so we'll leave the squawk there, and we've got the information here. So you're seeing bids coming in across the equities complex. I think we're on now for potentially, gap close on the Nasdaq up here on 13,464s. You got to, you can't just be buying this thing at market, playing for that. The risk profile, especially on the Nasdaq, is wide. I have to say, you seeing the resistance coming in here, 4204 on the bottom of the range on the SPOs. It's a little bit disconcerting, but the buyers have been hitting this right now, so seeing quite a bit of excess there. Yeah, so the volatility range is going to be put in now already from this event. So you're seeing equities trying to hold this push right now, but the rejection is pretty decent coming back down off of that. Dollar has gone offered on this move. So you're seeing euro and cable both appreciate up just a little bit, but taking it back right now. Support seen on S2 on the dollar, but I think generally curve for the dollar is down to the S3 over the next, down to 102 spot 4's area over the next session, and probably the rest of this session. For the elite teams, some nice action there on SPOs. RPBL 4184 is about to offer itself up here. Quite clean action. So shout out to YouTube if anyone's watching on YouTube or watching after the event on YouTube. Glad you decided to tune in and have a look at one of these Fed decisions and the volatility that you get on it. I'm gonna leave the dollar out of the picture and bring up the VIX again, which is on the top right of your screen. Actually, we'll keep the dollar index on and we'll keep the VIX up. You see the VIX now dropping. Support's down at 27.15s and 26.75s. Just to make you fully aware of some of these levels, here's the daily bar on the VIX. This 26.75s is actually a weekly support area at the moment now as we're trading above. So we are kind of, generally we're pulling back from bids that we saw there on Monday into the VIX above 32.81s. Now we're heading down to 27.15s is what I'm seeing on this thing. It's not a linear move, as is always the case with these markets. The moves are not linear, and it's within those. Timing that move is how you minimize your risk profile, right? So you're seeing euro now really starting to get into its stride. So we've got 25 minutes, 24 minutes now in a second coming up for Jerome Powell to read out his statement, which has already been published at 7:00, and then we'll get into Q&A. So generally, you do see the sort of directionality hold, and then the volatility sort of dissipates, and you can wind up very close to where you started by the time Jerome starts speaking. The currency moves, of course, can be pretty tricky. Once Jerome starts speaking, answering some questions and answers. Some questions, I mean, from the press, from global press. Well, actually, it's national press. Well, no, it's global. Sorry. So yeah, I mean, if you got to be quick to kind of work profits in these markets, especially on this sort of high volatility, because generally you only get about probably 10 minutes on the volatility, and then the markets settle down, and then sort of get into sort of trending, if you like. So and then that kind of dies down, and then you get into the Q&A, and you have sort of more volatility. And traditionally, from trading these events, you get more sort of dollar driven moves, right? You're just seeing a bit of a pullback here on the VIX, top right of your screen. And certainly heading south now on equities after reaching up into these highs. 4204 is top or bottom of the range. Actually seeing the sellers chowing down on that. Bit of a last stand for the Dow in this area of support. Generally kind of around supports around 33 110s. So definitely a last stand for the buyers here. If they can't defend kind of just this area, 33 110s, the sellers are gonna make a serious amount of hay while the sun shines on them here. So you got, with all these events, you have to be cognizant that a lot of this is priced in. So if you're sort of a newbie trader, you're going to be sitting here thinking, hold on a second, Fed have just raised 50 basis points. Surely that's negative for equities. And you are certainly seeing it's we're not ripping to the upside here, but the initial reaction is a move up. And I'm always saying it. You got to be cognizant of what is priced in and what is not priced in into these markets. They're seeing oil is while oil is appreciating here, a little bit of dollar weakness, probably not so much of a big deal here. While there is a correlation to be had there, the dollar really has to move quite a bit for that correlation to kick in and let oil then drift to the upside. Gold obviously on the bid, weaker dollar, stronger gold, bonds pretty much steady where they are right now. And just look at that range on the Nasdaq there that we've seen. Yeah, still very tight for equities here. Really, yeah, we're not seeing a huge amount of buying coming in at the moment at all. If anything, these equities are under the cosh, especially the SPOOs here on the bottom of the range. That recent movement, 4204 quarter. Seen a lot of sellers taking profits out of that. Probably dip buyers from Monday, standing out of the way and waiting for Jerome to come on. Got 11 minutes now. So you can see equities really struggling to hold above this morning trend that we've identified. I mean, the Dow is definitely holding here. It just remains to be seen if equities can actually sustain this amount of buying. And at the moment, we're seeing the SPOs not able to hold a key area here. In the VIX holding here, just bring that back into view for everybody. All right, how's everyone doing on the team here? All right, you're seeing the sellers now chowing down on these 4204s on the SPOs, getting their way here. Pretty much flat on the day on SPOs, down zero point 0.2 on NASDAQ and positive zero point 0.2 on Dow, but I don't think that's going to last too long on the Dow here. Seems to be breaking. Sorry to hear that, Lewis. Yeah, Ollie's probably in the pub, 4 pints in right now. Nice work, Parwiz. Yeah, it'd be worth watching, Parwiz, for sure. I mean, you're definitely something could pop its head above the water here. Definitely a lot of stuff moving here quite nicely. Just keeping an eye on the VIX here as it pushes back on VWAP. 2843's VWAP. Seeing SPOOs getting pretty rattled here, looking very, very heavy. Now we're coming back to pivot, and there you go. Pivot's just broken on the SPOs. This was APAC low, basically, and quite an important break line earlier on to the downside. So you're seeing that really bedding in here quite a bit. We've got about 8.5 minutes now for Jerome. So you're seeing similar rejection areas on the Dow that we saw yesterday, late in the session, around 4:30 there, sort of in here. I thought Ollie already had a pink Lamborghini. I'm still trying to get him to buy a canary yellow one. I seeing the VIX coming up here, finding it hard to get actually on VWAP. Sorry, it keeps going off the screen. I need to do that. All right, there we go. Seeing the dollar actually backing up to where it was pre-decision. Now, something I was talking about in the pre-US video and earlier on today was this absolutely lethal area in the NASDAQ. This is really, look what's happening here now. Bids again from the lows. A little bit of excess on 13,029s and back up we go here. So it's absolutely, bit of a repeat from yesterday. .6 minutes to the press. Gonna try and see if I can run the Dow back on up here. So I will have Jerome live on this feed. If you want to get the feed yourself live from your own YouTube, I'll post that link in the Discord right now. That's the Fed live. However, it'll be the same audio streamed here. Cutting the Dow. Back on the Dow.
Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years. It will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance
Seeing
sheet.
dollar strength on the back of
I'll
these
have more
opening
to say about
comments here.
today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued.
Out of Dow Longs.
Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. there is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Chamaros of the Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right, 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration, really, of how tight the labor market really is, the fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand.
Just to interject here, so we are seeing equities. It's a bit of a repeat of yesterday's session in a way, excess below, and then bidding back up into the top of this range. So you can see clearly where there is trouble for the SPOOs here. 42.04 quarter, Dow 33.303s. You know, it's really tricky, But generally, I'm saying with longs on equities here, longs on euro, shorts on the dollar. All right, let's go back to PayPal.
And they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so
right, you got the VIX back down on the lows of day here. I'm expecting another push down to 27.15 support,
strong and
that is going to lift equities just that another little bit over onto the hill.
I do expect that this will be very challenging. It's not going to be easy, and it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate.
And here you go with the VIX now, pushing new lows on the day here on the VIX. Another push up on equities, just as advertised. Again, it's another incremental low, not quite there yet. Pushing, here we go with the VIX. We may push through this 27.15s and destroy the support that it may offer on the VIX. But you're seeing now equities on new highs on day, on SPOOs. Well, no, sorry, not on SPOOs, on the Dow.
The committee is actively considering.
SPOOs on NASDAQ yet to follow for new highs on the session.
We raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial.
All right, so you saw that there. VIX is down on 27.15s. I don't think that's going to be it for the low on the VIX here. Even the 26.75s below. Just taking a little bit of cheese off the table on equities on that push. You are going to probably see a little bit of VIX buying coming in here. Just a little bit. It's going to cause a bit of turbulence for these equities markets. And on Dow, that level area 33,400s that we were talking about earlier has actually traded on pretty much highs of day for the Dow. Let's see if we can drive up through there. But I think this and the next mile up for Dow certainly has got a little bit of headwind, I have to say. So
we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate? Or
I don't think 1 month is not no 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort. As I said,
Back
we've
in a
got
second.
2 months now where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But again, our expectation is if we see what we expect to see, then we would have 50 basis point increases on the table at the next 2 meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the
Slow and
Financial
chip.
Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
Just coming back off of Jerome here, you are seeing the VIX now dropping below the 27.15s, letting these equities get up here. So just to give you the context of this level, this is sort of a weekly level going back to about September of last year. So if we give it up on 26.75s, we can really drop off here. All right, really drop off here, and that is going to be upside on equities. But straight away, you're seeing a little bit of support coming in there, just pipped in there now. All right, these equities are really driving now. So let's hand back to Jerome.
We're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
All right, you see the euro here. Seeing that's it. That's it for the dollar. Jerome's talked it off here. Jerome's blown off the top on the Dixie here. Let me show you. All right, that's it, really. We're going to need a re-escalation of the whole situation in Ukraine now for the dollar to find a bid here. But the top is in for now. That's it. Seeing the euro now screaming up. Quasi, I hope you're loving it. Nice trade, man. Really well waited for as well. Well done. All right, so you put in 103 spot 82s on USD spot index here. That is the high, right? That is the high here of 2017. Put in the 2nd of January 2017, Monday. It was a Monday. I do not remember it that well. Anyway, so here we are coming off of that high. You're seeing the euro now. Minimize that. You're seeing the euro really getting up 0.75% on the day. Target up 1.065 60s. But for me, this is a bigger trade than just in this session. I think not only can we get on to this upper level 560s, but I think we're going back up. Let's see what we can get, though. We're not getting rate hikes in the Eurozone from the ECB until July, but I think we can certainly do something here. Right, I'm 85% out of the longs on equities here.
Again, you don't see those things yet, but I would say there's no basis for feeling comfortable about that. It's a risk that we simply can't run that risk. We can't allow a wage price spiral to happen.
Just to make you aware of where we are on the SPOOs now from this drive. Okay, so here, let me drop the VIX off. You're seeing that support on the bottom coming in on VIX. See, we're still not, this still doesn't look like the most bullish chart I've ever seen in my life, but we are testing on this trend put in from, sorry, hold on a second. Let me get this lined up here. Okay, the low of the 24th of Feb this year and the low of the 15th of March this year. Trend was broken. We're now back testing that on the highs. SPOOS is finding some resistance here. All right, so that's why I'm pretty much 85% out of this thing. And actually, I think I'm just gonna watch the VIX as it trades here on the 2675s as support, and that's going to be my key element to decide whether I want to stay with long on the equities overnight on this or not.
And you can see it in the product markets as well. But I guess
target up CVAH 33,638. That's Dow 33,638. And MPVAL 33,657. Dow 33,657 MPVAL.
People almost suffer more from food and energy shocks than.
Arwiz. Oh, you anyone trading the Nasdaq?
But the second thing is that they're both capable.
Any brave soldiers?
Preventing further progress in supply chain, in supply chains healing, and so, or even making
Elam, you on that one?
So they're not. They're going to.
Elam,
sorry. Weigh on the process.
Keep having Elon Musk in my head.
Healing, which is going to affect broader inflation too. So they're
the Nasdaq was wild as shit there. Absolutely wild as shit. Look at the bottom on a lot of this stuff here. Unbelievable. All right, but I think we are now on for the gap close in this session. Not sure, but 13,464's quarter is the top of that gap close. It's also got a similar thing on the SPOOs here, and I think I don't know. I'm hesitant to call that right now. It's got a lot of headwinds here. I think 259s. We could do 259s on this session. 259s, and that's just shy of the gap. So could tag the gap. Yeah, I think we could tag the gap. But then I think we may head south again. Right, just bring the VIX back up here because we are piercing this level and we are now below 26.60 or 75 support. So staying with the longs on equities. Just running runners here.
Job vacancies to unemployed people. There's a lot of excess demand. There are more than 5 million more.
For the Duggan Capital team, you'll probably see MPVAL on SPOOs 42.54 looming large. Quite a lot of resistance to be found up there for that market.
If you can't, you would look at core inflation, which wouldn't include the commodity price shocks, and that's one of the reasons we would tend to focus on that because we can.
New highs, SPOOs, new highs Dow, new highs Nasdaq. VIX handsomely down now through the 26.75 support. So we have a bit of a country mile to go for the next support level here on the VIX. 24.28 is the next significant level. We're down about 8% on the VIX right now. 8%. Let me pull up some of the big cap names. Bottom left of your screen, you're seeing Apple's up 2.6%. Boeing up 1%. BP up 1.89%. Lovely. Facebook up 3.75%. Had a really crappy start to the session. Google. Sorry, going back to Jerome here.
First of the year. How are you mapping that into household consumption? Have they come down enough? Do you need another leg down in equity values to think that households are going to stop spending at the rate you need them to stop spending?
Okay, so in terms of the vacancies to unemployment ratio, we don't have a goal in mind. There's no specific number that we're saying we got to get to that. It's really you've got to get to a place
I'm
where
all out doubt.
The labor market appears to be more in balance, and
Still
that depends
SPOOs.
not only on the level of those things. It depends on how well the matching function in the labor markets are working. Because the longer these expansions go
Definitely
on, you
willing
get very
to
efficient
re-enter.
with all of that, and
Willing
the
to
beverage
re-enter.
curve shifts out, and that also tends to.
Right, willing to re-enter on a pullback, but I'm not going to be at my desk that long. Interested is may flip to the short side here on the Dow. Actually, I'm going to just put a little bit of risk on this.
related to that. We don't focus on any one market, the equity market or the housing market, or we focus on financial conditions broadly. So we wouldn't be targeting any one market, as you suggest, for going up or down, or taking a view on whether it's at a good level or a bad level. We just would be looking at very broad measures of financial conditions, all the different financial conditions indexes, for example, which include equity, but they also include debt and many other
still
things,
riding
credit
squeeze long.
spreads, things like that too.
Very tight risk on this. Stopped. All right, so that's me done on the Dow for the day.
Hi, Chair Powell. Rachel Siegel here from the Washington Post. To follow up from your message from the very beginning, what is your message to the American people about when they will start to feel the effects of, say, a 50 basis point rate hikes or multiple hikes? How do you explain to them what that does to their grocery bill or their rent or their gas bill? Thank you.
So, for the first thing to say is that we understand, and some of us are old enough to have lived through high inflation, and many aren't, but it's
the
very
dollar now really heading south there.
It's just something people don't, when they experience it for the first time. You're paying more for the same thing. If you're a normal economic person, then you're probably don't have that much extra, to spend, and it's immediately hitting your spending on groceries, on gasoline, on energy and things like that. So we understand the pain involved. So how do you get out of that? And it's our job to make sure that inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for. Perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates. So higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
Thank you, Edward.
Thank you, Chair Powell. Edward Lawrence with the Fox Business Network. So you've talked in the past about consumer spending and how that's drives the economy. Are you concerned with this high level of inflation that the consumer will stop spending, pushing us into, and what's the level of your concern, pushing us into a recession?
So the economy is doing fairly well. We expect growth to be solid this year, and we see household spending and business investment as fairly strong, even in the first quarter, which was relatively slow on some other fronts. So, and the labor market. If you look at the labor market, for people who are out of work and looking, there are lots of job opportunities. Wages are moving up at rates that haven't been seen in quite a long time. So it's a good time to be a worker looking to either change jobs or get a wage increase in your current job. So it's a strong economy, and nothing about it suggests that it's close to or vulnerable to a recession. Now, of course, given events around the world and fading fiscal policy effects and higher rates, you could see some slower economic activity. Certainly it will not be. Last year was an extraordinarily strong growth year as we recovered from the pandemic. As I mentioned, growth over 5%. But most forecasters have growth this year at a solid pace, above 2%.
But we've talked with economists who have advised Democrats and Republican presidents who both said that the Fed is so far behind
scaled
the curve
into
of
longs on
inflation
SPOOs.
that a recession
Keep a good hedge here for
So, and as I said,
between
I
short
think
Dow, long SPOOs.
We have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy.
Yeah, so pretty evenly spread now. initiating shorts around here on the Dow and just scaled back in on longs on the SPOs.
Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance, and they're famously
Dropping
blunt
the
tools.
Dow.
They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward, but there's certainly a plausible path to this, and I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Steve Dorsey.
Thanks, Steve Dorsey, CBS. You mentioned earlier, just now, fading fiscal policy. Do you feel that the Fed has been supported enough from policies at the White House and in Congress in combating inflation?
It's really the Fed that has responsibility for price stability, and we take whatever arrives at the Fed in terms of fiscal activity. We take it as a given, and we don't evaluate it. We don't.
Okay, so we're going to close it off there. The rest of these questions will be pretty benign. Just to recap on what we've seen here. So, just hold on a sec. Let me recap here. Recap. Yeah. All right. So really, for a full, basically, I think we had mixed results. Buying, then selling on the statement. Just let me get the audio off here. We are buying, then selling on the statement coming out. Then we remained quite bid, coming into the statement. Then went offer down. Only to find really good buying opportunities there for these markets. I'm going to flatten out here. They're pretty much done on the SPOs and the Dow for the session. So, the selling coming down, then as Jerome was talking, and finding really good buying opportunities for these markets. As you can see, the dips that we did experience then through his opening statements really were fantastic buying opportunity areas, for younger traders or starting out traders, young and old. If you haven't really been traded a couple of these events, you're going to see the selling down as something that's just going to keep going forever. And it really takes a bit of experience to kind of get to a place where you can you're waiting for it to sell down and get cheap enough to be good value. And then, if you have a decent edge, to exploit, then you are able to buy into weakness on the tape, selling down. It allows you to be brave where most people will be scared. And that's the benefit of having a really good edge. So anyway, we then, really, it's when Jerome came out and said that they were not looking at 75 basis point increases, saying, and I quote, that's not something they're considering or actively considering if they see what they expect they're going to see. So the market really did take that as a really good signal and a dovish signal, which it was. Now, under hawkish circumstances we are generally in a rate hiking cycle, but generally that's a dovish tone for the market. As I was saying before we came on here, there is that potential for the 75 basis point hikes times 2 at the tail end of the year. Well, that's sort of taking that off the table. A bit of dovishness for these markets. New all-time highs for the summer. I'd like to know what Sam North says, but I'm pretty sure I know what Sam North is going to say, and he'd just say buy as much as you can get right now. So 50 basis points times 3, May, June, July. It's priced in. All right. You're seeing a lot of green on the screen here on these big cap names. Actually, I don't need to blow it up on full screen here, but Just looking at the VIX down 8.2%, Apple up 2.7%, Amazon trading flat on the day, actually. Boeing up 1.1%, BP off of the back of great earnings yesterday, up 1.72%, again from up 8% yesterday. Goldman Sachs 1.5%, Home Depot 2.8%, Morgan Stanley up 3%. McDonald's up 2.7 for the 2% dividend. Hunters, Tesla up 2.1. All right, so I think generally equities are gonna make hay out of all of this. The dollar, it's on the barbecue. It's been rubbed in a special sauce called the euro and rate hiking in the eurozone. It's also been rubbed down with the war risk is priced in. I think we've had a great run on the dollar. As a European, I do want to see this dollar head south for the rest of the year, and I think the good times for the Dixie are over. Saying that, we've come back to test on this trend I was talking about earlier on S3. But what I want to see for the rest of this week, especially over NFP, is that we just head south below this kind of 102.40s level. All right, that's it from me for another Whopper NFC. Hope everyone enjoyed that session. I know it's not for most, but really good levels traded today. Definitely worth waiting for. NFP this Friday, and to the guys in the room, the elite team, everyone in the Discord. I'll see you tomorrow morning. All right, have a good evening. I'll see you in the morning. Bye bye.